So good morning. Welcome to our summer client webinar. I'm absolutely delighted to be joined by Ben Kumar, who's the Senior Investment Strategist at 7IM. Morning, Ben. Ben was last with us back in January last year. Since then, the last 18 months has flown by, and it's certainly been an interesting and quite volatile time for global markets and economies for us to look back on. Our agenda for today is quite brief, as you'll see. I'm going to give a bit of an introduction to the market backdrop we've had so far this year. And then Ben's going to expand and talk about some of the reasons we've had for recent market movements, how we can learn some lessons from the past to apply to our future decision making, and how to keep calm in the unstable environment we're in at the moment. As ever, we'll have the ability to take questions and answers at the end. With Zoom, you've got the ability to add questions as we go, so please do so. Ask anything you like. We'll get to the questions when we can. If we don't have any time, if we run out of time, we'll make sure we get back to you after the webinar's finished. So by way of an introduction, I just wanted to look back at sort of some of the market moves we've had this year. It goes without saying it's been a very challenging and volatile first half of the year for many investment markets worldwide, and this chart sort of highlights that. This chart shows the performance of many global indices over the first 6 months of the year. Just going to pick out a couple of lines on the charts. The green line at the bottom is the previous darling of the last few years in terms of market returns, being the big US index, the S&P 500, which returned over a negative return of over 20% over the period. I think that's the first time that's happened since early 1970. So yeah, it's been a very strong turnaround in returns from the US market, and as you can see, a lot of other global markets have followed that similar trajectory. Perhaps something of an anomaly is the blue line on the chart, which is actually the FTSE 100, and you can see that's actually gone sideways rather than down. I say it's a bit of an anomaly because that's probably caused by the composition of the index more so than other factors. If you think about some of the big companies that make up the UK FTSE 100, we've got quite a strong weighting towards sectors that actually have been beneficiaries of the global environment we've seen so far this year. Thinking about sectors such as energy companies, resources, mining companies, and also defence stocks. It's also worth noting that 70%, I think, or so of the UK FTSE 100's earnings are derived overseas, and therefore the weakness we've seen in sterling has actually helped convert those back and prop up the FTSE 100 returns. Probably a much truer representation of the state, I guess, of the wider UK market at present is the red line on the chart, which is the FTSE 250, which is the next 250 biggest companies in the UK. So probably a bit more of a diverse and broad-based sector composition, and you can see that was nearly a negative 20% fall as well over the period. One other line I just wanted to pick out. I appreciate it's quite a busy chart and quite tricky to pick out the lines, but the orange line on this chart is the UK government bond index, the all stocks, and we've also seen double-digit declines from government bonds and indeed broader-based fixed interest markets. Typically, bonds are held within a portfolio as a diversifier away from equities, and you can see that by being quite correlated in terms of both delivering negative returns, the impact has been that most UK investors and most indeed global investors have suffered similar declines and quite significant declines in their portfolio values over the first 6 months of the year. So not a particularly sort of upbeat chart, but as we'll go on to in the presentation, it's one that we don't think should necessarily strike fear and panic into the hearts of investors. This one is a very short-term chart, and we would very much caution against judging investments over a period of 3 weeks, as this chart is. But it does highlight a point I think Ben will come on to and expand on a bit later on, in terms of turning points and market moves can arise quite quickly and quite unexpectedly. This just shows the first 3 weeks of July, so since that previous chart, and we can see that actually many markets have had quite a lift, really, actually in the last week of that period. Indeed, some of those indices that really struggled, namely the FTSE 250, which is top of the pile, had quite a strong bounce. And as we'll go on to talk about, staying invested, remaining patient, and not being fearful can make sure that investors don't miss those bounces and rises when they occur. And just finally, I think probably this chart is a good one to leave on from myself. This is a longer term time period, and one very much that we would say is more akin to the time periods that investments should be judged over. This is a 20-year chart to the middle of the year. Obviously, along the way over the last 20 years, it hasn't all been plain sailing. We've had some periods of significant volatility, such as the first 6 months of the year. Obviously, going back a couple of years to the pandemic, we can see that on the chart, and the severe shock to financial markets that caused. And obviously, also we had the great financial crisis 2007-8, and again, a bear market and recessionary period from there, which markets then recovered from. So we would very much advise against judging investments over that long term, making sure obviously that fits with clients' financial objectives and financial strategies, which again are very much long-term strategies. Typically with clients, we're dealing with multi-year, if not multi-decade planning, and that's the horizon we should be judging investments. So hopefully that sets the scene well for Ben to expand on some of these themes. Just before I hand over, Ben, just another reminder, please do submit your questions. We love these sessions to be interactive, and it's a good opportunity to hear from Ben and ask him, and indeed ask any questions you have of myself around SG matters as well. So hopefully that sets the scene. Ben, I'll hand over to you.
Thanks, Henry. I think the part of being an investor and managing money is doing exactly what's said on the screen, recognizing when there is an unstable environment and doing everything you can not to panic. Because if you go to the next slide, you can see what I think is a pretty good stylized cycle for how markets work. Economic fundamentals don't change too much. They certainly don't change very quickly. One of the most famous investors, Howard Marks, says, most of the time things are goodish, and that's a pretty fair description of economics. The thing that we see in markets, though, is this investor sentiment, and you can see that just a small change in the narrative, as the economic fundamentals get slightly weaker, fluctuate over time, can lead to this massive transition from optimism to pessimism, or from greed to fear. And it's exactly one of those transitions that we think we're going through at the moment. The economic fundamentals, if you take a 5-year average view, are pretty good. The IMF yesterday came out and said global growth is going to be about 3.2%, which is about where it's been on average over the last 15 years. The problem is last year, the global economy grew at 6%. Because of the post-pandemic bounce. So people are reacting to that change down to 3%. That's half what we did last year. It must be terrible. Well, no, it's the long run average. Things are goodish. But they don't feel like it. If you go on the next chart, you can see what I think is a really nice proxy. Google searches for recession. When people worry about things, obviously this didn't happen 20 or 30 years ago. They didn't have Google. You'd have probably heard the word recession muttered more in pubs or in workplaces, but now people just go online. Is a recession going to happen? And you can see that the last time we had fear about a recession, in the general public consciousness, was 2020, obviously with the pandemic, and before that, back in 2008. When people are scared, it takes time before their minds change. And it will take a material shift in the economic data for people to, I think, shift out of that fear mentality. So if we have an idea of how the economic data might look over the next few months, we can probably get an idea of whether this unstable environment is going to continue. And as the next sort of 4 or 5 charts are going to show, the data is unlikely to get significantly better. And it's for a really, really good reason. The same one that I've talked about already. The data was so good in 2021 because of that post-pandemic bounce that everything is going to look relatively worse. Manufacturing on the screen in front of you. When the pandemic happened, we all did pretty much the same thing. We all sat at home and we got to know our delivery drivers really, really well because they brought us again and again and again the things we were spending our money on just to try and while away those days, whether it was, new yoga mats for the yoga fad, whether it was new cooking implements because everyone decided they wanted to make their own pasta. We all know we spent loads of money. And when you look at the actual data, there was 13 years growth of spending on goods in that 2-year period. Now, that's not going to continue at the same trend. You've seen a few companies really start to talk about this recently, actually. Shopify, the Canadian sort of Amazon style company, has let go 10% of its workers yesterday because it said, we thought that there was going to be a continued growth like we saw in the last 2 years, and that hasn't materialized. And we all know why, because we are getting out there and doing things now. There's only so many fridges and yoga mats you need to buy. You want to go to a restaurant, you want to go to a show, you want to see your friends, you want to go on holiday. So this spending on goods is going to come down. And I suspect if you look in 5 years' time, what you'll see is the fall you saw in the pandemic, the spike you saw as we were all at home, and then another fall again, and it will go back to the long-term trend. If you look out on a long enough time horizon, you'll see the trend maintains, but it's going to feel quite bad as that spending unwinds over the next 12 months or so. The data won't be as good as people need it to be. If you go on to the next slide, you can see the problem that's going to cause for another part of the economy. Corporates, companies, again, we're looking at the US here, but the story is very much the same all over the world. Profit margins for companies during the pandemic became extremely high. Why was that? Well, a number of reasons. Interest rates were incredibly low, so their debt didn't cost them anything. They weren't spending on things like travel for their employees, whether it's planes, whether it's accommodation. And we saw that spike up in demand. So for companies, it was really a perfect environment. The other thing as well is, of course, that the government was paying some of their employees' wages. They didn't need to necessarily change tack on that. So when it comes to corporate earnings, interest rates are going up, workers are getting paid a little bit more, and that demand's going to slow. The margins that companies make are going to fall. It doesn't mean it's a disaster, but it does mean that the numbers, at least the change in the numbers, is going to be negative over the next few months.
Ben, would it be fair to say that there's going to be differences within sectors and indeed regions on that level? So actually, there's still going to be different levels of opportunity around that.
Yeah, absolutely. And I think your point on the FTSE 100 was a great one earlier. If you're if there's an index like the S&P 500 or like some of the ones in Japan where there's a lot of manufactured goods or a lot of advertising revenue, those profit margins are ones that are likely to be hit. You've seen Facebook warning about it. You've seen the likes of Google saying advertising spend is falling, at the same time as you've seen manufacturers say, whoa, we're not producing, or we've got a lot of inventory piling up and people aren't wanting so much of it. Whereas if you do look at the likes of the FTSE 100 and the miners in there, or the energy companies in there, or indeed the healthcare companies in there, those margins are likely to be a little bit more resilient because, as we know, the price of oil is high. Lots of the energy companies, have almost a tap they can just turn on at no great cost to them. So margins in areas like the FTSE 100, I think, are a little bit more protected. If you're in the consumer discretionary space, the retail space that did so well, your Shopify's, your Etsy's, your eBay's, and your Amazon's, things are a little bit more challenging. So it's a really good point that once you start going a little bit deeper, there are still good opportunities. I think for the general perception though, and I saw it yesterday, Amazon comes out and says we're raising the price of Prime, we're struggling with inflation, and the share price falls by 5%. Those headlines keep that fear cycle going. And if we talk about inflation, if you see the next slide, there is no chance that it's going to leave the headlines anytime soon. Now, over the long term, this is the Bank of England's forecast for inflation. They expect inflation to settle around target 2%. Given that that's their aim, you'd expect that. If you look at market forecasts as well, there's the 5-year expectations for inflation are actually pretty much at long-term average in the UK and in the US. The inflation shock is expected to be just that. However, I think we all are still coming to terms with price rises in the goods, in everyday goods. And we haven't had that for, maybe 2-3 decades. So that fear factor, as inflation hits up, ticks up towards double digits, is very, very real, and it will keep people nervous. The other people that will keep nervous, if you go to the next slide, is the policymakers. I've got the US central banks estimates of where they think interest rates are going to be at the end of 2022. So they get asked this every quarter or so and give their responses. And it goes back to 2019. So in 2019, where do you think interest rates are going to be? Where's the target rate going to be? And the point is not where they say, the point is how quickly those expectations change. In 2019, they thought it was going to be about 2.5%. Boom, pandemic, suddenly it's on the floor. But then, after a year or so, suddenly they're ratcheting things up and we're now at 3.5%. The policymakers have no crystal ball when it comes to the economy or investing. They are doing their best to try and bring inflation down and to try and find the neutral rate. But it's very clear that there's disagreement among the various committees. There's disagreement between central banks across the world. Japan resolutely keeping interest rates low while the Federal Reserve hiking them, the UK somewhere in between. There's a lot of uncertainty in the interest rate outlook. And that is another thing that makes people nervous. I know I've heard a lot of questions from some of my friends who have mortgages about what to do. Are rates going up or are they going down? And the answer is both and neither, depending on your time horizon.
We have actually had a question, and I said we were going to take questions at the end, but seeing as we're sort of talking about rates and the outlook, it's probably pertinent just to jump in. Not necessarily interest rates, but obviously they're inherently linked. Is the question around annuity rates, and the question was what was the or what may be the outlook for short and medium term, and I guess the answer's quite similar in terms of annuity rates because of their linkage.
Yeah, absolutely. Annuity rates are directly related to the base interest rate, but the question I think, particularly with annuities, that people have to be aware of is it's not just the interest rate; it's what inflation is as well. So if inflation is at 0, an annuity of 2% might be pretty reasonable. But if inflation is at 10%, an annuity of 7% is still not particularly useful to you. So, I think until this short-term uncertainty about inflation moderates, I think looking at annuity rates for, particularly for the long term, isn't necessarily going to be an easy thing to do. You don't know what the inflation picture is going to be. So how can you know what the right annuity rate to purchase is?
And just from a financial planning point, obviously, typically an annuity is quite a fixed contract. There are some flexibilities around it sometimes, but making sure that decision is right and is appropriate for sort of financial planning needs, not just in terms of meeting your need for expenditure long term against inflation, but also for other benefits in terms of provision of legacies and things like that. It's quite a complex question to answer, and one which very much should be looked at individually, alongside clients' advisors, I think.
Absolutely. One of the things we always try and say is, inflation, although the headlines will tell you it's there, everyone has their own inflation number. Everyone has their own different basket of spending that could be increasing or decreasing at a different rate to everyone else in the country. So yeah, as you say, it's an individual decision that needs to be taken really carefully. The final uncertainty, which I think is no surprise to anyone listening, is the energy outlook. We know one of the reasons for the shift in energy prices is what's going on in Ukraine, and the Russian response to that, the supply response. At the same time, over the last, call it 10 years or so, there's been underinvestment in energy infrastructure because of the shift towards a greener economy. So there are fewer taps to turn on, as it were, and it takes a while to drill a new well or open a new pipeline. So the energy outlook is incredibly uncertain. The price of gas as we go into exit summer and go into the winter, who knows where it's going to be, particularly in Europe. We saw something in the US the other day, maybe about a month ago. There are only 3 natural gas export terminals in the US, and one of them caught on fire. Suddenly, that's a third of the US's ability to export natural gas offline for a month or so, and the price responds accordingly. There's so many moving parts in the global energy environment, and to be clear, in general, I'm very skeptical of people, particularly strategists, commodity strategists, who come in and say, I know where oil is going to be in a year or 2 years. It's difficult to predict at the best of times, and I think we're all clear that this is not the best of times. So another uncertainty to add onto the pile. If you take all of those, it's perhaps no surprise, if you go on to the next slide, as Henry said, that in terms of equity returns, this was the worst first 6 months of a year since John F. Kennedy was president of the United States back in 1962. Now that's a pretty alarming statistic on its own. Okay, wow, this is really, really uncertain times. If you go to the next slide, when you look at bond markets, those havens of stability, this is the worst first 6 months of the year since George Washington was president of the United States. So the fact that even in the part of the portfolio that's meant to be stable, that part is having a 3-century period of unusual returns. Now, until the uncertainties we've just talked about start to fade, this kind of volatility is I think the norm. Now, it doesn't necessarily mean negative, because volatility, risk, whatever it is, it could mean that people decide that bonds are going to have the best year time since 1788. The point is that it's really uncertain, and there are never any quick fixes in investment, but particularly at the moment, there is no clear direction and there are no clear trends. So being very conservative and staying diversified is, I think, there is no better time for it than this. I want to talk a little bit about fear over the next couple of slides, though, because I think when you look at the psychology of it, and I spent some time doing a psychology master's a few years ago, the human brain is not good at keeping calm. And it makes sense from an evolutionary point of view, as we'll come on to talk about. But in the modern world, it becomes particularly challenging. And when you have headlines, when you have social media and doom scrolling and all of that stuff, it becomes even more challenging. So there is a part of our brains called the amygdala. There's actually 2 little bits on either side of the brainstem. And the amygdala has a pretty important role. If you go to the next slide, what the amygdala does is take the experiences that are in front of you and store them in your memory banks. It does it so we can learn. That is the whole point of memories. If something happens, you want to learn from it, whether you do that again, whether you don't do that again, whether you maybe do something differently. The thing is, though, it's not like a computer hard drive where you just save it down and it saves exactly what's happened. You're not running a recording of the world and saving it down. The amygdala makes decisions. So on the left amygdala, everything is recorded. It is just a video. Okay, great. You played the lottery and lost, put that in the memory banks. You played a football game and won, put that in the memory banks. You had a good day, a bad day, whatever. The right amygdala, though, is only on the lookout for negative news. All it wants to do is find events to learn from. All it needs to do is say, okay, was that dangerous? Was it scary? Well, did we get hurt doing it? If so, put it into the memory banks, tagged as do not do that again, or worry about that. Now, from an evolutionary standpoint, it makes complete sense. You want to have a negative bias to your memories, because the minute you see something that even looks like a tiger or a lion or a predator, you want to be running. You don't want to be weighing up the balance of, oh, is it something that's going to eat me, or is it something that's, that doesn't? The minute you see a fire, you want to be running out of the building. And then, that is quite useful even in modern day life. If you're crossing a road, you don't want to be weighing up the balance of probabilities that the car will or won't hit you. You just want to get out of the way of something coming at you. So it makes sense from a survival point of view, but it's absolutely terrible for consuming news in general, and news particularly about finances, because in general, when it comes to markets, you don't see many headlines saying another normal day in markets, things going up steadily. You don't hear about the financial markets until you hear something like FTSE loses £2 billion of value in the day, something like that. So your right amygdala is looking out for that bad news. It's relating it to your current situation, your savings, your retirement, and going, things aren't good here. So it makes it even harder to keep calm when there is uncertainty, because every single time something bad happens, it's going to be overemphasized by your brain. So
I was just going to say, perhaps there's also a point with regards to news on a similar vein, that actually the quantity of news that's out there that people have access to these days, through all of the different platforms, it's not TV anymore, as we know. People consume their news online, on phones and things, and the sheer quantity of news, and as you say, sometimes more balanced towards the bad news, it must have an impact as well.
Absolutely. There was a bit of research done in 2017 that says, I think it's the bias in this. They did look at newspapers, although I suspect it'd be worse on Twitter. In newspapers and in broadcast news, is 3 negative news items for every 1 good one. So not only is your brain unbalanced, the world, the way we give our headlines to each other and the way we communicate is unbalanced as well. So, it becomes incredibly difficult, if you go to the next slide, to end up like this guy when the market is falling. We know that our brain is not going to be helping us. So one of the things that we try and do as investors is gain perspective. Now, it's very difficult when there is something going on that you think you need to be, that your brain is being scared of, to get that perspective. So we try and do it ahead of time, and we try and talk through, with our clients and with ourselves on the team, some common lessons that we've learned over over all of the various crises and not crises that we see. And over the next few charts, I've got a few of these that I think help to give some of that perspective. So the first one, if you move on, is, and I've taken it for Ukraine, but you could have done it for Brexit, you could have done it for Donald Trump's election. Instant reactions can be dangerous. So on the day that Russia invaded Ukraine, 24th February, the most global markets fell. Now, the US market opens latest because they're however many hours behind us. So you would have thought that the US market over the course of the day would fall. The US market opened up down 3%, but over the course of the day rallied by 6% to end up 3%. So if you'd have woken up, seen all global markets down, US to open, you'd have assumed that the US would finish the day down. And yet it finished up by 3%. Those instant reactions from markets as information is processed, as people go through that fear and panic and then maybe move to optimism, can be really misleading. So simply doing things and the instant you hear news can be a very damaging thing to do. Neither number, up 3%, down 3%, has much information in it, but you could have you could have either missed out on 6% of gains, or you could have made 6% of gains none of which had anything to do with information. The same is true when you looked at the Brexit vote. The FTSE was down 7% overnight and then finished the day up. The same is true when Donald Trump was elected. The market fell by 5% and then rallied by 5%. These instant reactions can be really dangerous and really violent. So doing nothing is often a pretty useful thing to do when you hear news for the first time. In general, actually, if you go to the next slide, timing the market is a pretty difficult thing to do. So lots of the investments, when you look at our investment funds or many others, the main game is staying invested, is not reacting. I think this is a great slide to remind us of that perspective. If you look over the last 20 years and have just bought the FTSE 100 and taken your dividends and reinvested them, if you'd have just done that, you'd have made 5.5% a year. Not amazing, but you were coming out of the 2001 tech crunch. You've had the global financial crisis, you've had Brexit, and you've had a COVID pandemic. 5.5% is not too bad, I don't think, really. But had you just missed the 5 best days of that, you'd have lost 2% of that return, 2% annualized. You'd suddenly at 3.5%. If you missed the 30 best days, just been out of the market for the 30 best days, you've suddenly got a negative return over that 20-year period. So, that's a really, really stark thing to think about. If you'd have just missed a month of investing over that 20-year period, you'd have had a negative return.
As you say there as well, I think you put steal words out of your mouth probably, but is when those best days occur as well. It's quite often when you're most fearful, is it not?
Oh, absolutely. So, they often occur within, the day after one of the worst days. But a good example, a more recent example, I think, is the bottom of the market during COVID, right, when markets were at their absolute lowest worldwide, was the 23rd of March, which was the day we went into lockdown in the UK. So that would have been the absolute best day to buy. For the last probably 10 years or so, that would have been the best day to invest your money in the equity market. But no one was thinking about that. Everyone was panic buying pasta and looking for loo roll in the local shops. Those best days, the 24th of June was a really good day in the investment world, came just at the moment of max panic. So just staying invested at least keeps you there for the best days as well as the worst days. Looking at the next one, and it goes back a little bit to what I said earlier, when you look at the daily price movements of markets, you can look over the long term and you can look over the short term, it tends to be about half and half. Half days are up, 58%, and half the days are down. But we know that the amygdala is going to overemphasize those down days. So if you look at the market every single day, you will see about the same number of negatives as positives, but your brain's going to react more to the negatives. It's where one of the other psychological theories, loss aversion, comes from as well. We feel losses about twice as much as we enjoy wins. If you lose £20, you're going to be more annoyed about it than if you get given £20. And if that doesn't ring it, if you increase the numbers, you start to see it. If you lose £2,000, you're going to start to be really, really annoyed. If you get £2,000, it's probably a good day, but it's not amazing. So just the simple fact of looking at the market more often means you're going to be exposed to more negative news, which means you're going to end up being a little bit more scared. If you go on to the next slide, which looks over the long term, I think there's a really good message here. So if you look over 32 years or so, the global equity index is up something like 600%. You've increased your money by 6 times. If you look daily, as I just said, there were 54% of the days were positive, 46% were negative. If you looked weekly, same, 50-50. But when you get onto monthly and quarterly and yearly, the longer you leave between times you look, the more likely you are to see positive days. And I think that's really, really important. If I could have kind of one power, it would be to suggest that people look at their portfolios only once every 10 years. Because when you look once every 10 years, essentially I think it's about 95% of the periods are positive on 10-year returns, only 5% are negative. If you turn that to 20 years, it's 100% of the time. Of course, we have to have reviews, and people like myself have to look at the markets to see whether there are any opportunities. But ultimately, looking less will make you a much, much happier person. I always think as well, actually, and I've said this on a few calls, my favorite investor is actually my mum, who logged in to her ISA account, set up the direct debit, put it all into equity markets, and then promptly forgot her password. And that was about maybe 12 years ago. And I think we looked 2 years ago during the pandemic, because you have nothing else to do. And she had a lovely surprise, because she'd had 10 years of increased returns and saw that whatever money she'd put in had gone up. And she said, well, I thought there was a pandemic and everyone was worried. Why am I doing so well? That's a brilliant way to invest, not to just not look at all. If we go to the next slide, I think this is I'm coming to the end now of this perspective point, but I think all of these have an impact. There is always something going on in the world. This goes back to 2008. Just picks out some events that you could have been nervous about that might have made you want to sell. Whatever we've got. California has worst drought in history. Perhaps poignantly, in 2014, Russia moves troops into Crimea. First confirmed COVID case. S&P downgrades US credit rating. Deep Horizon oil spill. There's always something going on, and those negatives are always going to be in the news. All of these were headlines at one point or another. But over the course of this period, over this 12, 14-year period, £10,000 has turned into £43,000. Or at any point, you could have been looking at something that might have scared you enough to leave the market. But had you just stuck with it, those returns do mount up over time. The final one, and this is, I think, the final one, I think there might be one more after this, it is about bear markets. Everyone talks about them, everyone talks about recessions, but going back to the war, essentially the Second World War, they are very, very rare compared to bull markets, and they tend to be really, really short. People tend not to know, so the average bear market is 11 months. People tend to spend, say, 3 or 4 months of a bear market saying this isn't a bear market. Then they spend about 3 or 4 months saying, oh, maybe this is a bear market, perhaps I should be selling. And by then, they're about 3 or 4 months away from it turning into a bull market again. Even when things are scary, and the US index you showed at the start, down 20%, even when things are scary, if the index is already down 20%, the likelihood is you've taken most of the pain already. It might be a good time to start adding. The bear markets don't come around very often, and when they do, they're often over really, really quickly. And to go back to the point that you made at the start, Henry, you never know what's going to change people's mind. Who knows whether it's a great statement of results from a company, or whether it's a piece of economic news, or a politician, seems unlikely, but a politician does something good and sensible for the economy. Or any of these things can change, and you'll never, ever see the catalyst coming. Staying invested, is pretty much always the best thing to do. I think, is there one more chart?
There's one more on that point.
Yeah. I this one. So just to emphasize one more time on the staying invested, what we've got here is we used our fund because we have the data for it. If you'd invested in the 7IM balanced fund in 2006, as it were, and held it all the way through everything, doing just what I said, not looking at the markets, not selling, you'd have made about 100%. You'd have doubled your money, which is not too bad going through a recession, going through COVID, going through Brexit, and so on. If, though, you'd sold in November 2008, and we did have some clients who got scared, got worried, and then bought back in a year later, once the market had recovered and rallied, you'd only have made about, I think 60% had you held all the way through to today. That B
that's
on
the blue
chart.
line. Yeah,
that's the blue line. If, though, and we do have, there are some clients who never learn. If you'd done that, you'd sold out in 2008, bought back in, and then COVID had happened, and you'd sold out on that worst day, March 20th, 23rd even, 2020, you would have made only 20%. So, you're waiting around for the market to recover is so difficult to do. You spent 2 years out of the market over a 14-year period, and suddenly your returns are at 20% rather than 100%. It's really important to stay invested, and it's really important to remember that when the market is falling enough to hurt you. At that point, most likely over time, the thing to do is stay invested and potentially even invest more. I think that's where advisors are so important, Henry, because you need someone to remind you of that. You need that relationship, that trust that's built up over time to remind people not to sell out. And if we can get, if we can get everyone in that green line just by doing nothing, I think we're doing a great job for our clients. It's what we're paid for.
Absolutely, yeah, I was going to very much say that. But also making sure that A is appropriate for clients' needs and circumstances, because obviously, people will have needs along the way, and that's when the overarching sort of financial plan and strategy comes in. And by regularly reviewing that strategic plan with clients, making sure that when they've got needs that are arising, say in November 2008, actually the capital they might need for those needs are already safeguarded well in advance of that. So that's where that trust, that dialogue, that communication with clients comes in, and evolving that financial strategy every time. So the money that should be invested for the long term can be invested for the long term, I guess.
Absolutely. Having a plan that you can stick to is sort of the most important part, and that's where, as you say, you come in to build that, knowing that sometimes it's going to be scary, and you want to give everyone the best chance of doing the long term right thing.
Good. Well, I think that's a good sort of point to end the sort of formal proceedings on. So yes, thanks very much, Ben. I think certainly putting that in perspective, verbalizing some of that, I think is very good, and hopefully some clients have found that very reassuring. It's easy to say, it's maybe slightly less easy to sort of to understand and sit back and think about it when you are feeling fearful and panicked. So I think sort of the more we can do in terms of provide that reassurance that the long-termism is the right mindset and philosophy to have, the better, really. We've got a couple of specific questions now that obviously, whilst you're here, clients have sort of looked to take advantage of your knowledge and insight. We'll rattle through them. They're a diverse little set. We've taken the annuity one already. One, they're all quite topical, actually. So the first one is around climate change. So the question is, given that climate change is happening, is that a threat or an opportunity to investment portfolios? I guess.
So yeah,
big question, but maybe pick out a couple of key points from that, possibly.
Yeah. So I think there are elements of both, and it depends what time scale you are talking about. I think there are huge opportunities when it comes to the shift I think we're seeing in the world towards less damaging ways to live life is the way I think about it. And it's not just green energy. People who make solar panels or wind farms. It's everything. It's the example I always use is the Tetra Pak family who made the folding cartons were one of the richest families in the world and still are incredibly wealthy, and they just made packaging that worked. The company or the person that invents properly reusable packaging for everyday items is going to be in the same position. When you think about your takeaway boxes, none of them are recyclable yet, but they will be. So it's not just in the space of electric cars and solar power, but there's the whole shift when it's packaging, when it's products, when it's waste disposal, when it's furniture. There are opportunities out there that businesses are going to be able to take advantage of. At the same time, though, I think there are a couple of threats, as it were. One is, what is the outlook for old energy businesses. And I think, the death of fossil fuels has been overemphasized. I think the last, call it 6 months, has reminded us how much we do rely on gas and oil and so on, and that the transition away from them is going to be a lot longer than people have expected. So I think the threat of abandoning investment in traditional energy sources is one that people need to be aware of. Some of these companies are going to need investment. It is actually a little bit of an opportunity as well in some of the big energy companies, if they can make money now from the, shall we call it, damaging fossil fuel extraction, but use some of that profits to invest in other cleaner generation methods. That is an opportunity. And the likes of Shell and BP are in fact the largest spenders on research and development in the clean energy area. They're not, the people that run these companies are not blind to what's happening. They know they need to, on a 30-year view, change the way they operate. So that's one. In terms of threats, don't discount the importance of large energy companies yet. The other is, I think, greenwashing. There are a lot of products out there that are, I think, opportunistic, and they will kind of play on the branding, play on the idea that people want to be doing well, and not really be doing anything about that. And there is a product that I found. This was a couple of years ago. It still exists, but it's called the vegan ETF, which sounds incredibly on trend. But when you look under the hood, it's not doing at all what you'd expect. A vegan ETF, I would expect, is looking, maybe technologies for advanced creation of meat or fake meat products, where it could be looking at more sustainable ways to, I don't know, replace leather, replace plastic, whatever it is. But when you look under the hood of that vegan ETF, and if you look on the website of it, there's nice pictures of rainforests and outreach programs in disadvantaged areas of the world. It looks lovely. Look under the hood of it, and it owns Microsoft, Facebook, Amazon, Apple. None of those companies are, in my mind, vegan. I'm not necessarily sure I know what a vegan company is, but what they've got there is some good packaging around a product that is not doing what it says on the tin. So that distraction, if you like, that potential for something that looks like it's doing good but isn't, is I think a threat, because people are getting sucked in to these kind of things. There are worse examples out there where people are genuinely saying we're using this for good and then going out and mowing down forests and things. But I think just that headline risk of getting sucked into something that looks good but maybe you don't understand is a real one for investors.
Good, thanks. Couple more questions. One which crops up surprisingly often is around cryptocurrencies, and actually is whether the long-term philosophy still applies to that asset class, given the volatility they've had this year. Perhaps, yeah, I've always provided quite a cynical sort of response about the investable nature of cryptocurrencies as part of our types of investment solutions for clients. But what's your take on that?
I think it's a bit soon to be calling cryptocurrency an asset class. The first bonds were issued sometime around the Roman Empire. So, people kind of get how bonds work. The first equities 400 odd years ago. We've had a bit of time to understand them. Commodities have been around for thousands of years. Property has been around for thousands of years. The interesting thing about crypto is it is potentially new and exciting, but there are no characteristics to it that I think you can understand on the long-term view. By which I mean, with an equity, I get it. You own part of a company, and if the company does well, you'll benefit in that. With a bond, I get it. You've lent someone money and you're going to get a return on it. With commodities, you hope that there's going to be demand for it in the future because people need it for industrial processes. And for property, you live in it and hopefully someone will either buy it off you or rent it off you. Those are all understandable. With cryptocurrency, lots of the suggestions for why it might be useful haven't stood up. Is it a stable form of cash? Well, no, not if you look at the price of it. Is it an inflation hedge? Well, inflation's at double digits this year, and cryptocurrency is down about 50%. So it doesn't seem to be doing a great job of being an inflation hedge. Is it going to be a new way to do fast digital payments? Potentially, but Tesla, one of the most advanced digital companies there is, has just stopped using Bitcoin. Is it going to provide for a cleaner, greener environment? Well, no, not on electricity consumption. So the fundamental bits for crypto, I think, don't add up. And I think anyone who is investing in crypto should be immediately writing that money down to zero. Assume if it's money you are happy to lose and it won't mean that much to you, put it in. And absolutely, I will confess, to when was it, 2017, I did exactly that. I had, I think, about £1,000, and I put it into cryptocurrency because I thought, I work in finance and this might be exciting. And I watched it double, and I watched it halve, and I watched it halve again and halve again, knowing though that was money that I could afford to lose, right? That I did not need. I didn't rely on it for my pension, for my savings, for anything. So if you do, if you want to get excited about crypto, I think it's completely possible and completely doable. But I would always assume that, like going to a day at the races, you don't expect to come home with a profit. You expect it, you've gone for something quite different. So I'm very skeptical that crypto will be finding its way into investors' portfolio. Definitely at 7IM, and I think in general, it's not gonna make its way into portfolios anytime soon.
Good. Yeah, I'd agree. And then the final question, which I guess you probably would have predicted that was going to be submitted. Again, very topical, given the debates we've been seeing on TV, or not, as the case was last night.
Yeah.
Who do you think would be better for the UK economy and markets, Liz Truss or Rishi Sunak?
So there's a couple of answers. The long-term one is that politics tends not to matter for markets. The US election cycle does not matter for markets. And if the biggest country in the world, the largest economic power in the world, politics doesn't matter, then in the UK, a small island off Europe, politics is even less likely to matter. Particularly true when portfolios like ours and like many of our peers are globally diversified. It matters even less. For example, you mentioned the FTSE 100. Who's in charge in the UK is not going to matter too much for the likes of BP and Shell. They're more concerned with what's the price of oil and what can they sell it at. So that's the long-term answer, which is don't spend too much time thinking about it, especially if you've got diversification in foreign currencies as well, so that protects against whatever happens to sterling. Having said that, my personal view is that the economically conservative candidate is Rishi Sunak, and his economic plan, as it were, is pretty much in line with what's going on in the likes of the US and Europe. It is, you don't start cutting taxes until you've solved the inflation problem. The very much non-consensus economic view is Liz Truss's, and I think there's been some examples, certainly in recent history, if you look at Turkey, where people have tried, the Turkish president tried to tackle inflation in a different way. The theory is when inflation goes up, you raise interest rates and that will eventually bring it down. In Turkey, the central bank cut interest rates instead, and inflation spiraled out of control. So every time, although the kind of traditional economic approach isn't that enjoyable and doesn't seem particularly clever, everything else that has been tried so far in history hasn't worked. So I think in terms of view of Britain as a kind of understandable Western economic environment, it's probably better to have Rishi Sunak. But who knows on Liz Truss? The thing I would also say when it comes to politics is, when people get into office, they find that quite a lot of their big statements that they made are, subject to reality. I'm sure Boris Johnson had lots of plans and they didn't involve a pandemic. So I think ultimately it won't matter too much. Our portfolios, it won't matter too much. And I think there's also the last thing I'll say is just, at the moment, it's the strangest thing is how out of our hands it is. with, a very limited group of Conservative Party members being the ones who make this decision. So, predicting it is incredibly difficult, and predicting what the outcome will be of whatever the result is just as difficult. If I were to bring it back to one thing, it'd be, I was talking about an unstable environment. I don't think this political situation is helping that.
No, not at all. No, well, certainly, as you said, I mean, the whole theme of the presentation has been uncertainty and lack of clarity, but trying to look through that for that long-term approach. And but hopefully, as we get some of these uncertainties that do start to lift, they are positive, and that might, that again is another certainty that the markets will then have to be able to interpret and deal with, I guess. So for everyone's sake, let's get some of these uncertainties off the table and then start to move forward.
Yes,
that would be good. Good. Well, I think that's been absolutely fascinating. Best part of an hour. I'm sure I speak on behalf of everyone on the call, all the clients, to say thanks very much for your insight and knowledge. Hope everyone has enjoyed it. But because we've sort of just about to run out of time, I think we should bring it to a halt here. If there are any other questions at all about what's going on, we do understand that times like this do raise concerns. So please just get in touch with your normal wealth manager contact, talk through your financial plan. If you want to dig a bit deeper into markets and things like that, please just reach out to us as well. We'd also be very grateful if people on the call could complete the feedback questionnaire. I think they get sent out at the end of the call. It's also a suggestion to make opportunities to make suggestions about which topics we should cover again. These aren't solely investment focused webinars. We do some thematic stuff. Last time we looked at estate planning based on demand from clients. So please provide some feedback. We'll be seeing you again in the autumn, so there's a good opportunity to look at that time at a few other topics as well. So that's it from me. Before I go, just thanks, Ben, again for your time. Thanks everyone for joining us on the call. Hope everyone enjoys the rest of the day, and hope everyone enjoys the rest of the summer. Make the most of the weather and things, and we look forward to seeing you again in the autumn. Thanks, Ben.